So it's kind of hard to believe, but we're coming towards the end of the day. And I want to make sure you don't run away on us. So after this next session, we're having a networking reception on the 3rd floor. And ACS very much welcomes you to be there, so stick around. Thereafter, dinner is at your pleasure. And so what I would like to do now is introduce one of our good friends from this region, the Ben Franklin folks. It's my pleasure to introduce Mark deGrandpre. Mark is Director of Investments for the Physical Sciences and Clean Tech program at the Ben Franklin Technology Partners of Southeastern PA. Mark has over 25 years of experience with innovative business and technology development. After receiving his PhD in organic chemistry at UCLA with Professor Donald Cram, Mark joined the Roman Haas Company in the research division. Currently at Ben Franklin, he is responsible for a portfolio of over 30 young physical chemical companies in the region and for identifying new investment opportunities. Mark is an active participant as an investor and advisor for these emerging companies, lending support in strategic and financial matters. By the way, Ben Franklin is a real player. They have more than $165 million of investment and 1,750 regional enterprises across all sectors of technology. So Mark is presenting his views on venture mentoring, the good, the bad, and a few question marks. I think that's for you to ask him. I have an idea of what that might be, but I'm not going to steal Mark's thunder. So we're very delighted to have Mark with us, so please join me in welcoming Mark deGrandpre. Mark?
Thank you. Thank you. Thanks, Ken. I'm going to see if I can take this. If you don't mind, I think what I'll try to do is speak from up here. I know this is the end of a long day to try to reach you a little more directly. I was thinking about back a number of years ago, I had to give a presentation at the end of the day. I was in the UK. And it was me separating the audience from drinks. So I gave this presentation, and I thought I did a great job. The audience seemed engaged. Everything looked good. And after the presentation, this man came up to me, sort of poking his finger at my chest, Scotsman, and said, you know what your problem is? He says, you spoke too long, you spoke too fast, and worst of all, you cut into my drinking time. So I was kind of reeling a little bit. And then the host of the session came up to me. He saw me talking to Robert and saw my reaction was a little flustered. So he comes up to me and says, oh, I see you talking to Robert. Don't pay any attention to him. He just repeats everything he hears. So I hope I don't get into the same problem here today. So when Ken asked me to talk a little bit about mentoring and about advice to your business, I tried to think, how can I make this a presentation that could last an hour? Because basically, it's a good thing. So mentoring is good, advice is good. So there's the bottom line message. But how can I expand on that a little bit to try to talk a little bit more in depth about where you might find resources and how you use them? So that's what I'm going to talk about now. And I'm really going to start talking a little bit about Ben Franklin Technology Partners. How many of you are regional folks here, live in the region? So you may have some familiarity with Ben Franklin Technology Partners, some of you may not. So let me take about 5 minutes just kind of introduce who we are. The Ben Franklin Technology Partners were created in 1982. Basically, there was folks in the Pennsylvania legislature said, you know what? The industries that powered Pennsylvania for the first couple hundred years of its existence probably won't power Pennsylvania forever. So what do we have to do about it? And the thought was, we need to bring more technology or science or engineering-related companies to help fuel Pennsylvania for the next century and more. So the Ben Franklin Technology Partners were created largely to focus on technology-based entrepreneurship. So if you are an entrepreneur focusing on engineering, science, or technology, you're within the wheelhouse of Ben Franklin. And the way that we were crafted is the state of Pennsylvania is actually divided into 4 regions. And my Ben Franklin is in the southeast quadrant here, the smallest one. We only serve 5 counties in the Philadelphia area. There's other Ben Franklins that service other parts of the state. But if you look, it's interesting. We have now about 130 companies, young companies in our portfolio. We're a very active investor. In fact, we're probably, in terms of number of deals that we do, about 10th or 11th active in the United States in terms of the number of deals we do. Now, we don't do huge deals capital-wise, but we are a very active investor. We'll put about $6 or $7 million in the street every year into about 25 or so companies. So maybe the top folks in the United States, you have the Kleiner Perkins, maybe do 60, 65 deals a year. We're not that far behind in terms of that next tier down in terms of number of companies. So we see a lot of companies, we see what works and we see what doesn't work. One of my reports when I was at Roman Haas told me, this is many years ago, he said, you know, the secret to being smart is not so much your native intelligence, but it really comes down to pattern recognition. If you can recognize patterns earlier and faster than most people, that's sort of the key to being smart. So I always say that when I give a talk here, I'm not telling you the things that I know because fundamentally I understand them. I just recognize the patterns of all the companies we see. If you see a bunch of companies come through, you can see patterns of what works and what doesn't work and where we can be of assistance to companies. So don't take my word for it. Take the fact that we're seeing a lot of companies. We just have a big database to play from. We've been doing this since 1982. I can tell you that we do a good job. I think, is this still on? Am I projecting well enough in case this doesn't come on? You know, I can tell you that we do a good job, but I think what we've been recognized as doing pretty well is accelerating technology-based ventures for the last 30 years or so. And we have a number of different accolades from all sorts of folks across the United States, locally and nationally. So I'm not going to go through all these accolades that we have, but what we do, I think we're recognized as doing it pretty well. A lot of other states in the United States have kind of kicked the tires on our model of how do you create and incubate and get new businesses started. So, you know, I think the success model we had has now been emulated by other states in trying to get these young companies into the place where they're functioning, they're growing, and they're creating to the wealth of their regions. So let me start off with a myth. And this has been reinforced in this today a number of times. But one of the myths that entrepreneurs have, and I assume many of you are thinking about, can I start my own business? Can I make a go of it? One of the big myths is, all I need is money. Get me money. Now remember, my role is I write checks to good people. I mean, companies come for money, and they come to Ben Franklin because typically we're investing maybe $100,000 to $500,000 in these ventures. We're an early seed stage investor. All they want is money. And what we tell them, if you want a check and us to throw the check over the transom, then you're not right for us. Because we've learned over the years, through that pattern recognition, that's what's really important is not just the money, but it's all the other things that go with it. The reason you're in this room is trying to get the skills and capabilities to grow your business. And sometimes that's more important than the money itself. So we have developed a tagline that says, you know, money, knowledge, and networks really make the difference to the company, not just money. In fact, a few years ago, I read in the New York Times, Kleiner Perkins, one of the largest, most active venture firms in the United States, one of their comments in the article in the New York Times was, the least important thing that we bring to the table is money, yet they're probably the biggest venture group in the United States. So the idea of mentorship, the idea of getting that input, the idea of using the networks is so critical to you as a company that if you do it poorly, you set yourself up for the risk of not maximizing your opportunity. As I said, our little moniker is capital, knowledge, and networks. We believe that the three of those combined will create new companies, new products, new jobs, new opportunities for people. So you really need the influx of those three. As I mentioned, we're a seed investor. We typically will invest anywhere from $100,000 to $750,000 over a lifetime of a company. Companies need to bring in the match money. We don't do the heavy lifting ourselves. I always say we can always win a best supporting actor or actress, but never the lead actor or actress because we need to have other money in the deal. But we also do a lot more, is that we are working with our companies all the time. We provide the mentorship, the assistance, and we are there working with those folks on sometimes daily basis if problems come up, because we recognize that kind of help makes the difference between success or failure many, many times. So what have we done, just to give you an idea of what we've been doing? Just over the last decade or so, we've invested over $65 million. We've touched almost 500 companies. These companies have created, just in the 5-county Philadelphia, remember, we're not just one of 4 Ben Franklin. So in this area alone, almost 3,500 jobs created. Now again, this is not all in chemicals and materials. We invest in IT, we invest in life sciences, so we have a broad portfolio. But these are technology or engineering or science-based companies 3,500 jobs. What's pretty impressive is, remember, we're giving them a kickstart. We're a seed investor. These companies have gone on to raise from other sources of capital over $1 billion. So there's been $1 billion of influx from later stage investors to the companies we find. We've had partnerships with universities that brought in almost $1 billion to the region. And then finally, we did a lot of work in securing a great coup for Philadelphia, which is this DOE innovation hub around energy efficient building technology that was now part of the Navy Yard, which is where we're located in Philadelphia. So that's a little bit about us. This is kind of an eye chart, but it's just to give you an idea of since the 80s, some of the companies we've invested in. Some of them you may have strong name recognition, and we touched them when we were very early. Some of them maybe not. But what I do tell folks who come to us as entrepreneurs, I say, listen, you don't have to come to us for capital if you don't believe you have legs to be a billion-dollar business, because the wealth and the diversity of this region depends on good big companies, good medium-sized companies, and good small companies. So you don't have to feel apologetic that you don't think you can be the next Dow or the next Google. That's okay. And we've touched companies that are some big, some medium, some small, but all of them really good contributors to Ben Franklin and to the region. So let's talk a little bit, after the introduction to Ben Franklin, let's talk a little bit about the challenges you're going to face. And this is the reality for most businesses if you are going to be raising money, starting your business, if you're thinking about doing that. Let's look what happens typically over time. Now, remember, unless you're very wealthy and you can fund your own effort, you're going to be beholden to and going to other people for money. The problem is, as soon as you start your business, you are going to be spending money, whether it's for patents, whether it's for, prototype development, whether it's for employees. I don't know, there'll be a bunch of things you're going to spend money on. But as you start spending money, if you notice on that red curve on the bottom, that's sort of the sum of your accumulated earnings. Well, if when you start, you are now going negative, because for the most part, we touch a lot of companies that are pre-revenue. You haven't started selling your product yet. So if you haven't sold anything, you're spending money. You're probably not spending all of your own money. You're spending someone else's money, which makes it more complicated. And you're losing money. So now, what are the challenges you're going to face? One of the challenges you face is, how are you going to keep getting money? You go in your financials are, well, I'm losing, but please give me more. I need more. Write me a check for more. I wish Michael had stayed, because I know a bunch of companies that could use $1 million or more, so he ran out of the room, but I could certainly use him for an access to some capital. So typically, when you start funding, you'll be going first to the 4 F's maybe, the family, friends, the founders, and fools. Those are the 4 groups that are going to be funding you early on. We are in that sort of next group of investors that are willing to take a bet on you, even though you're not making money. You might not be selling a product. You're burning money, but we're sort of that seed investor that comes in at the most precarious time of your life. Usually we're sort of in the same range as some of the angel investors. And I have to say that when you talk about, everybody talks about as a young entrepreneur, well, I'll go talk to these venture guys. Well, the venture guys usually won't even look at you until you have a certain amount of revenue, maybe a certain amount of earnings. So even though it might be chic to think of movies or TV shows where somehow you're going to get the attraction in the eye of a venture investor, venture investors in our world are very, very late on the curve. We're not an early stage investor. They'll love to talk to you and say, when and if you hit these milestones, come back to me. But it's usually a short and very polite conversation, and you need to do a lot of work before you get there. So how are you going to get there? How are you going to make it work when you're cash starved and you're very small? Well, it all comes down to this thing about mentoring and advising, and how do you leverage the skills and capabilities as a company that's very small and doesn't have a lot of capabilities. So here I talk about what's the fuss. Why the fuss about mentoring? I mean, why did you want to have mentoring as a discussion topic at this conference? And what I always tell entrepreneurs is, I've been around the planet a little while, and I can say unequivocally that I have met very, very, very few brilliant people in my life. I did work for a Nobel laureate when I did my PhD degree. He was not a Nobel laureate at the time, and I always like to think that my research put him over the edge. So I do suffer from delusional bouts of grandeur sometimes, so you have to put up with that. But there's very few people I put in that category. I met a lot of really good people, but not a lot of great people. So when you think about running the business and starting the business yourself, can you do all these things? Are you skilled at the sales and marketing? Are you skilled at raising capital? Are you skilled at legal, regulatory, patents? Are you skilled at purchasing, supply chain, manufacturing? Can you do it all, or can you not do it all? I think Michael said one of the key things was getting the right people. So I always tell entrepreneurs, at the earliest stages, you need to backfill for the skills and capabilities you don't have. Because more than likely, you are not that one person in what? A billion that has all these skills and capabilities. You are not a jack of all trades to the level you need to really propel this business. So you have to start reaching out and getting that advice and getting either mentors and advisors, and I'll talk a little bit about the difference between those. So again, unless you're 1 in a billion, think about very quickly augmenting the skills you need. Now, remember, I see a lot of technology-based entrepreneurs. So usually the entrepreneur is a technologist who has a better widget, a better material, a better something, and they want to build a business around it. In fact, most of the entrepreneurs Ben Franklin sees are of that ilk. What they tend to be missing the most, though, sorry, is that okay? Am I projecting loud enough? What they tend to be missing the most, though, are some of the absolute critical factors in building your business, which is around sales, marketing, finance, and accounting. And if you ever want to raise money from another party, those voices have to be incredibly strong and incredibly powerful. Because most of the time, in the early stages of a discussion, investors are going to grant you the fact that your technology works. You know, if they ever get to the point of due diligence, they'll uncover the pros and cons. If you tell them I can make if you tell them I have a time machine, they'll believe you until they do the due diligence. They're more concerned about the business plan of marketing and then monetizing the time machine. So if you are not skilled in sales and marketing, finance, or accounting, start getting those capabilities now, because that is the message you need to deliver to the folks who are going to write you those checks. More than likely, you're skilled in the research and development. That's usually the inventors we see. But backfilling with those skills and capabilities is absolutely important. Okay, so let's talk a little bit about your advisors. You know, what is the ideal advisor? I mean, I would say all my companies, this is what they want. Their dream advisor is going to be someone that provides absolute world-class advice, right? This is the part that you have to be real careful of. Usually people like advisors that agree with them. They share their fundamental beliefs. I'm going to talk about why I think that's not a good thing, but they want someone that agrees with them. They want someone that provides great advice, certainly someone that wants zero control, right? You're never going to cede control to anybody besides yourself. Has a network of contacts that is deep and broad and can get you to any company, any customer, anywhere in the world. Can also write checks. You know, if you run into a problem, this person can say, oh, you need $1 million? Oh, wait a second, I got that in my back pocket. And then fundamentally, because you're a young company, it's absolutely free. Isn't that great? You get all this advice, they do everything for you, and it doesn't cost you a nickel. That's your dream advisor. I have yet to meet the dream advisor yet. So let's talk a little bit about the reality of what might really work here. And I talk a little bit about what I consider and I'll talk a little about the roles of what I think each of the different class of advisors are and the advantages and some of the ways you work with them. I sort of, you know, when Ken talked about mentorship, I consider mentorship kind of very early on advice. But that advice, as your company grows, will morph into other relationships with advice. And that other relationships could be advisors and ultimately directors or board members. And you have to start thinking about the relationship that you have with each of these different classes of potential input, knowledge input to your business. Now, what I will say here is every one of these things can be used now and in parallel. So you don't use one to the exclusion of the other. So as you look forward, I want you to balance off the relationships you have with all your mentors, your advisors, and directors. So what's the real difference in my mind between a mentor, an advisor, and director? So to me, your mentor is usually the first person you meet, right? That you've met over the years. It's someone that you know as a friend, as a colleague. You know, these are people you've had in your network for quite a long time. The mentor is a very important role in the organization because if you look at the role and duty of the mentor, to me, the most important thing a mentor can provide to you is absolute candor and honesty about what you're doing. You know, it's kind of like, you know, do I look fat in these jeans? And they'll actually tell you the truth, right? Mentors will also be a sounding board. They'll have some connections for you. Start cultivating these relationships early. You probably already have them. I mean, you have colleagues and friends that are mentors you probably talk to all the time. It's a more informal relationship, but choose the ones that absolutely will tell you the honest truth. If you have a problem hiring people, firing people, raising money, are you projecting well when you go out to give your capital raise pitch and all that? You know, have someone that can say, listen, John, you know, you really shouldn't be doing this. You know, bring in some other help to do it. And that's where a mentor is really valuable. You know, they're usually friends, they're colleagues, but really you don't compensate them very much. I mean, you take them out to dinner, you have coffee, you share things over lunch or whatever, but the expectation is much more of a collegial relationship. As far as selection risk, what I mean by that is if you choose a poor mentor, how much does it kill you? And the answer is probably not much, because you can always change them. There's no real skin in the game of these mentors. They're there as mostly friends. Cultivate those relationships and use them, but recognize that without skin in the game, they're more sounding boards than anything. What I highly recommend you start doing in the early stage is think about putting together a set of advisors. And we'll talk about board members later. I differentiate advisors mostly because you are seeking people with very specific skills at that point. If you don't have skills in finance or accounting, or if you don't have skills in marketing, bring some people that really know and understand that world, that bring a specific competency and skill set, and start bringing them on and forming an informal or formal board of advisors. At this point, though, you know, you're going to start having to think about compensating them because you want them to have a little bit of skin in the game in your business. So you might be offering a board of advisors some equity, small equity stake in your business. But the expectation is they're going to do things that you can't do. And they're going to be part of the organization in a way that a pure mentorship relationship can't provide, for the most part. Ultimately, at the extreme of the business, and I talked about the selection risk. Obviously, if you have certain skills you need, providing the services and the complement of that advisor is important. But again, advisors can be changed out relatively easily. So while it's an important selection risk, it's not fatal if you do a mistake there. At the very end of the stage is going to be advice you get and mentorship you got from people that you really didn't invite into the business per se. Those are going to be your board of directors, and they largely come in with investors. If investors are investing your money, they will want you to have, more than likely, an active board, and they will have a board seat, which means you've now crossed the threshold from mentorship to control. These folks are going to demand that you provide a plan and you stick to your plan, and the relationship is more of a reporting relationship. It's not collegial anymore. You're reporting to that board of directors. And the difficulty you might have is if you go to investors, you may or may not be able to choose who's going to be on your board. And that relationship is absolutely critical. And I will tell you that when companies run into problems, the relationship among the founders and the board is absolutely critical, and it's sunk companies. Dysfunctional boards have sunk more companies than you couldn't believe. When you choose the directors, I think, and it might have been, I don't know if Mike said it or Mark said it. I think Mark Singer said it. When you choose investors and you're going to have that relationship with the board, that is absolutely a critical choice. Now, sometimes as a company, you might not have too many choices of where you get capital, so you feel kind of stuck. If these are the only guys or gals who are going to invest in my business, I mean, it comes with the territory. But choosing an investor and not having a compatible board member can be the kiss of death. So my certain suggestion here, and I think Mark Singer said the same thing as well, do your due diligence. Talk to other companies that have this investor who's bringing in board members. Find out the relationship and the input of those board members to your business. Absolutely vet your board before you create it, because they are going to be providing, I'll call it advice, but it's control and advice at the same time, and that relationship sets you apart from just purely a mentoring one. Obviously, the compensation goes higher as a board member. They'll be getting equity. They might be getting cash. They might be getting, and they'll want to have directors and officers insurance to provide liability for them if something goes wrong in the decision-making process. So it is much more of a formal relationship, but it is a relationship where there's going to be a lot of advice that goes across the transom. So I sort of characterize, these levels of mentorship that you'll experience over the lifetime of your business. And I put the note here to remind myself at the bottom that, if you want good advice, remember, you always have the choice to pay for good advice. If you want the best legal advice, you can hire some of the best lawyers. I mean, you can hire really good part-time CFO that gives you all the, you could hire someone to help you in fundraising. So there are ways that you can get mentorship, but it's going to cost you, and those are from the service providers. So I always balance the relationship of how much I'm willing to pay versus how much I expect for just that more of an informal relationship. Okay, when do you start? How quickly do you start putting together this group of mentors of all levels? And what I tell companies is do it now. My colleague Alan Krauss, who invests mostly in the IT space, he will not invest in a company that hasn't had a formal board or board of advisors set up. I'm not as restrictive. Some of my companies I think are maybe a little early to have a formal board. But basically, because you don't have all the skills to do anything, we want you to make sure that you bring in that talent early on to help guide you. Unless, again, you're one of the billion folks that know how to do everything really well. So do I need a board? Fundamentally, do I have to get a board? No. Most companies at the very early stages, you probably can get away with not having a formal relationship. You might not have any investors that demand a board seat, but my suggestion is at least get a group of advisors that you can meet with on a quarterly basis to try to make sure that you have a sounding board, they're bringing the skills and capabilities. By the way, I do want to go back to the board member duties. Would you get a board member? This is not a purely advising relationship. You need to bring someone who's going to, I call it, deliver the goods. He's going to, or she's going to get you access to a customer. They're going to get you into that account you've never been able to get into. They are going to have access to money that if you need that next round of capital, they are going to be able to deliver that. So if you're getting just advice at the board level stage, you have a big problem. Those board members have to do some heavy lifting. They're getting compensated and the expectation, and they have control. Make sure you use your board effectively and get those skills and capabilities from those members. The other thing I always say, for technology-based entrepreneurs, you're a great inventor, right? You're a great technologist, and you're telling me that you are going to be the key salesperson for this business and for your company. Okay, if you're a great salesperson, go recruit a board of advisors. If you cannot go out and get people that maybe you don't know that are still skilled experts to join you in your effort to help you grow your business, you're probably not a salesperson. And then you should start thinking about adding that dimension to your business. If you can't sell people, how are you going to sell your business? How are you going to sell your product? So I think the first acid test or litmus test of you as a salesperson entrepreneur, can you sell a group of people that you don't know to say, join with me because this is a big enough opportunity, it's an exciting opportunity. So think about that as your first sales test. Now, and I think maybe Mike always said this in the last session, never stop getting good input. You can keep drawing input from a lot of different sources. It never gets old, and always balance your input from different sources. Never get like-minded people who always think the same because you'll get into a very stagnant rut. Keep getting fresh voices, and it never will hurt you as a business. How about the mentorship? We talked fundamentally about mentors, right? And it always, everybody wants something for free, but a set of free clothes may or may not fit you real well, right? So that's the problem with free clothes. And it's the same thing with free mentors, right? There's a lot of places you can go for free advice. My suggestion is be very careful what you take in if it's free. Obviously, the more skin in the game from a relationship, the more that I think there's an onus or responsibility to deliver. Free advice can be very perfunctory, it can be very, very simple. Do this, do that, but whoever's giving the advice really doesn't have any stake in whether you do it or not, or whether you're successful or not. So my advice is you reach out to different sources of mentorship. Use that advice in aggregate. Don't rely on any one source. And where are you going to get all those mentors? How do you find the mentors? How do you find the source of advice? This is the fact that you're here says you're seeking that kind of advice, right? So you go to these type of resources. My advice is, besides colleagues, go to other entrepreneurs. I mean, it was funny. There was a question of, I think the question came up, should I be going back to school and augmenting my business skills? I think the answer is always yes, you can do that. But if you want to do it fast, talk to the guy or gal that's been there. They know it, they've lived it, and you can get that advice transferred a lot faster than you might be learning from the ground up. Now, I'm never saying you shouldn't go and do that, but time is of the essence, and I think part of the opportunity is just networking with those people who fundamentally have done this all the time. Talk to investors. I mean, investors, even though they might not invest, they have a wealth of contacts where they can direct you to other skills and other capabilities and other people. So if you don't know how to network super well, other investors could say, well, I know this business, I know this CEO, I know a person who's an ex-sales head of this other company. They might be willing to join you. Great source of mentoring and advice. Lawyers. Most law firms have a practice dealing with young companies. So if they have a practice dealing with young companies, they know of all that ecosystem of all the folks who are providing other services to those groups. And lawyers are a great source of contact within a region. Seminars like this, almost every region in the country has venture events or investing events. Get in there. I always say, listen, if you're going to fish where the fish are, right? And the fish are at the places that you want to start your business, and you have like-minded people in that ecosystem. Talk to potential customers. There are organizations like us in the local region. There's the SCORE group, which is this, I think, Society of Retired Executives. I can't remember what the C stands for. There's the local small business development centers. If you've never done a business plan, there are places to help you, guide you through doing your first business plan. So there are those organizations, and my suggestion is use them all in aggregate and start doing it as quickly as possible. Okay, advisors. Let's go from just from mentors to real advisors. Until the time is right to get a board, that advisor could be a proxy for a board. It's a really good thing. It shows other investors that you're really desiring a balanced viewpoint in running your business. Make sure you get them for very specific knowledge. You're backfilling what you don't know well. So these are folks that have very specific domain or subject matter expertise. They're generally not investors in the company. You might give them a little bit of compensation. They usually don't bring money, but they bring that specific advice. Again, they can be very, very helpful, in fact, critical to some. I mean, if you have never manufactured anything, bring someone that understands supply chain and manufacturing. Could be a godsend to your business. And you can and a board of advisors can coexist with a board. So it doesn't mean if you have a board of advisors, it means you have to jettison those once you get new money into the business. They can coexist peacefully. Okay, the last part: investors, 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 investors. Okay, what's the myth? The myth that investors are my friends. They're my buddies. They love me. Well, for a second, they love you. Investors aren't your friends, and investors aren't your adversaries. What investors are partners that sign on with you for a very limited amount of time. They will be, we always say sort of, offhand to a company, listen, we're with you, win or tie. And that's the mantra of investors. We're with you, win or tie. So remember that your interests are only partially aligned. They have specific objectives as an investor. You have a specific objective as a founder. When you first start out, those are pretty well aligned, but very quickly that alignment can get skewed. And when that alignment gets skewed with you as a founder and manager and that investor, you are in for some rough days ahead on that board. Be very careful how you choose these folks. So you go from initially from the oh yeah moment to the oh ho, ho, ho moment. And how do you go from oh yeah to oh crap? Well, you go from oh yeah to oh crap by a lot of things. You start running out of cash. You start missing the milestones that you yourself had said, this is why you're funding me. And you start missing those milestones. Stephen Wright said, if you think no one cares about you, try missing a couple payments. You think your board doesn't care for you, try missing a couple milestones. And believe me, they will start caring very quickly about what's going on in that business. If you have a strategic disagreement, which often happens when you have a board, right? I mean, you're no longer king of the mountain. You have to share that responsibility, and there's sometimes disagreements on how you roll out the business, your strategy. If your business development is slower than normal, and believe me, of the companies I've seen, not one company has ever hit its business plan. I will state unequivocally, you will not hit your business plan, which means that you will be behind from the day you start. And how you manage being behind is absolutely critical. And your relationship here with those mentors, advisors is fundamentally critical. You need more money? Talk about pleasant board conversations. I'm in all the time. We're running out of money, we need more. It always comes down to, and this is the part as an entrepreneur you got to think about, these discussions come down to control, 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 control. Who runs this business? You're going to be ceding control as soon as you bring in those other investors. How are you about ceding control? How are you about sharing it? How are you about looking at the right people to make sure that you're more in line with each other's objectives? Okay, finally, just some tips to consider. You know, network, I mean, this is obvious. Network, network, network. There's a lot of places you can get mentoring advice. Go out and reach out for it. You'll be surprised. If you're just where the fish are, it's not as hard. I'm not a natural networker, so you know, it's not easy to do. But if you're in the place where you just start seeing people all the time, you know, you just make connections, ask people. You'll be surprised. If you're an entrepreneur, surprisingly, or maybe unsurprisingly, people know how difficult it is. People reach out with help all the time. And they really do. I mean, you are doing the most difficult thing ever, trying to start a business from nothing and make it successful. You'll be surprised just how willingly people are willing to reach out and help you. So just reach out and you'll do it. Accept that free advice judiciously. Accept the free advice carefully. Select your investors and partners absolutely judiciously. Okay? I can't stress that enough. Make sure the people that are helping your business, reward them. You know, don't expect they're going to do this for free. If it's a formal advisory role, give them a stake in the business. You want them to continue to put input more than just occasional snippets of advice. When you have to, invest in the best people. You know, I tell companies all the time, I wasn't able to attend this morning on the patent session. I have strong feelings about certain patents. And whether, you know, if you have a seminal patent, if you really think you have a seminal patent, I mean, go tooth and nail and spend all the money you need to protect it. If it's something incremental, something marginal, be real careful about what you spend money on patents for versus just protecting it through trade secret knowledge. But invest in the best. If you have a great patent, invest in the best patent resource you can to have a patent strategy, because fundamentally the value of your business at exit will be largely determined by that IP portfolio. Well, not largely, partially determined by that IP portfolio. And I think a great term I heard from a board member sometime is seek friendly skeptics. You know, one board member told me, an independent board member, my role is to be a friendly skeptic, which means I'm not like the investor board members that will come out with you know, claws and tear you to shreds. But I'm not going to basically be a yes person to your business. So if you can seek a friendly skeptic, probably the greatest asset to your business. And those are the ones that will keep you on your toes and yet provide really good input. And then I said, and for all entrepreneurs, again, if first you don't succeed, then skydiving is definitely not for you. So I think with that in mind, I think I'm done. I think we're living proof of where mentorship and networks make a difference. So Ben Franklin, I just wanted to show some of the folks that we're aligned with in the region. We don't do it all ourselves. We recognize that relationship, that partnering mentor relationship, this is just a whole swath of some of the groups that we work with in the region. We do a lot with advocacy for policy as well. Again, we're not trying to lift the boat ourselves. We're working with a lot of partners. And I think the final slide is just an example of more companies that we've funded over the years. So with that, I thank you very much. I think there's a couple minutes for questions, and hope I didn't keep you too long from some libations. So thank you so much for listening. And if you have any questions, you know, follow up with me. I'll have tons of business cards, and I'm glad to share any perspectives that we can share.
We have time for questions. Questions for Mark? Okay. And I actually have one for you as well, Mark.
Hey, Mark, what are your criterions for investment? Like, obviously, one has to be in Pennsylvania.
Yeah, for Ben Franklin,
right.
You know, because we utilize in part some taxpayer money, the company has to have a presence in Pennsylvania. For us, it has to be in the 5 counties of Philadelphia. So that's one of the criteria. The other criteria are probably the same things you hear from other investors. You know, it's the quality of the business plan. We look a lot at the quality of the team. We look a lot at the quality of advisors. Again, who's going to be assisting your business? Because we don't expect you to be able to do it all. So those are more standard criteria.
So no valuation requirement, like 100,000. You know.
You mean valuation of the business?
The business at 1 million or something like that.
Now, I think for us, because we're an early stage investor, you know, typically our structure is investing with convertible debt. So we basically finesse that decision by waiting until another investor places a real valuation on the business, and then we can convert into equity at that stage. Because, you know, God love them. You know, you talk to investors at the early stage, they have no revenue, they have a long timeline to get products, and they say, well, my business is worth $10 million. And so we don't like to have that tough discussion with them, and we don't want to slap them around early on and try to get their heads straightened out. So we say, okay, sure, your business is worth $10 million. I'll invest in some debt, and then when you raise your next round of $20 million, I can convert. Of course, they raise their next round at $2.5 million, and we can convert if we want to at that stage. So we try to finesse that discussion. Entrepreneurs are very optimistic. They're an optimistic group.
Just a quick question. How do you evaluate your venture in your business? How do you evaluate? How do we
evaluate?
A company, a startup.
Sure. I mean, a company will come in with a business plan. Mm-hmm. We have a pretty formalized process by which we screen companies. But fundamentally, we put them through two checkpoints. We put them through a technology checkpoint where we sort of vet the technology of the business, and then we put them through an investability business checkpoint. We have volunteers from the region that sit on panels and committees that help us screen companies. Steve's here today. He sits on one of our panels for investability. So we get a lot of aggregate knowledge from people in the region, and so the companies are graded and scored. And they're graded and scored, again, on all those dimensions: strength of the business plan, technology, size of the market. Nothing atypical than what you'd think for any business.
All right, we got a couple of questions, and I want to squeeze this one in myself. I have noticed through my years that you would see entrepreneurs who I will call cheerleaders for their company, going to their advisors, going to their board, and maybe not being as candid as they should be. Now, you can understand, Mark, from your presentation that you have a limited partner, right? And I mean limited in time. Mark, what advice could you offer relative to delivering the bad news to people who are trying to help you?
Yes, good question. I have a very strong viewpoint on that. I can't say it's necessarily shared by everybody. But in a company that's very young, the most important asset of your business, maybe outside the IP, is your credibility as a leader. The credibility dollars that you've banked is an absolute critical asset. And if you go in and misrepresent your business, your potential, some of the things going on, then that bank account of credibility you have with the people around the table get depleted extremely rapidly. My feeling is, and I know entrepreneurs do it, they hate to deliver the bad news because they think, again, they're a very optimistic bunch. They think, well, it's bad now, but 3 weeks from now I get my new order and I get this and everything's rosy. I mean, they're always saying the next turn of the corner is going to be Oz, right? That's always the entrepreneur's viewpoint. It rarely is. So if you have to deliver bad news, deliver it. If you have a good set of advisors and directors, they will know that these things come, and you'll work together to sort it out. As soon as you try to misrepresent where you are, I think you're on the road to disaster in that interpersonal relationship with either your board, with your advisors, whatever. So be brutally honest. You're young companies. Bad things are going to happen. I told you, no one has hit a business plan yet. So you'll be an absolutely great company.
Hi, Mark. John So, I'm actually from Seton Hall University and also Dubois Enterprises. Great talk, and I was wondering if you had the thought of sending that last quote from Stephen Wright to Brian Cashman.
No, I haven't, but...
Okay. A quick question. What does BFTP get out of, let's say, investing $100,000 into a new startup company?
Okay, a number of different scenarios. If we just retain our investment as a debt, we don't convert it to equity, then hopefully we get the debt return with some interest. But our vanilla deal structure always has a little equity component. So we get some warrants in the deal. So there's always a little bit of upside with the company if the company really does stratospherically well. So I get my debt repaid, I get a little bit of interest, and I get an upside on the equity. Some of the deals we will do equity from the get-go. So we're like any other investor, potentially ranging from nothing to a nice return for us. But I have to say that from a Ben Franklin perspective, because we utilize in part some state funds, the folks who fund us don't expect us to get venture kind of returns. They're doing it because they want to see us find companies that create jobs, wealth, taxes in the region. So they have a different agenda. So we're very mindful of the fact that we have to balance job creation and economic growth and development along with just our returns. So our cost of capital for those companies in the region, our cost of capital compared to venture dollars is actually very low. in comparison, because we don't have those kind of targets.
Other questions?
Hi, I was wondering, great talk. I hope I get a copy of the slides from you at some point.
Sure.
But early on, one of your talks, it was the mentor advisor, and under advisor you said, oh, your advisors, you will give them sort of equity in the company. What percentage would that be?
Yeah.
Early on, it's sort of like it's just you, and then you've got to get a lot of advisors.
Yeah,
what is that percentage?
I've seen ranges, but I think that, I think as sort of a general rule of thumb, it's maybe 0.5% equity vested over a few years of service. So think about that kind of range. So if you have, if you have 3 or 4 advisors, you may be thinking about maybe that's 2% of the company that vets over 3 or 4 years if they continue to make, those kinds of contributions.
Question?
Just a comment to that. Advisors are often LLCs, and there's a legal restriction on that regards an LLC owning stock in something. So don't get caught in that. If you're an advisor or however that works, it's a serious issue.
Thank you. Other questions? Well, we're recording.
Thanks for your presentation. So is it better for a company that's a biotech startup to have milestones that include partnering with pharma, or is it better to have a bigger picture that we're going to grow this company into a standalone company that's going to market all of its products?
Yeah, and what I hesitate to do is not knowing any of the specifics to go on the line there. What I would say is more than likely, if you plan to take this company from this point to being an integrated manufacturer and seller of products, more than likely the capital requirements to do that are staggering. So basically what you have to do is have confidence that you can hit the milestones to keep raising enormous amounts of capital. On the other hand, if you say, listen, I want to take it this far and sell the business to a strategic, then you can go to an investor and say, I'm not going to need this much capital. I think I only need this much capital. So you may be more attractive from a standpoint of investability by that partner. I don't do the biotech portfolio that Jen Hart does, but I know that she's even staying away now from therapeutics. It's just that's such a lottery ticket game, huge money game. I think she's saying I'll look at device, I'll look at other things, but therapeutics, I mean, there's been a trail of, littered with dead bodies on that path. So, it's a high risk game. So if you envision doing that, just be sure that you have the skills and capabilities to potentially do fundraising beyond your wildest dreams, bringing that much capital. Yes. Even the angel investors in this region are staying away from those bets. And I was talking a little bit over lunch. I mean, the downside for materials, and I have some materials companies in my portfolio. The downside is, the path to commercialization usually is more expensive. And I forget the gentleman who said it really well, that, if you don't, I think it was Mark Singer. I mean, the reality that Mark said is, if you are doing a materials play and you go to a strategic partner and say, here's my technology, I've reduced this to practice. Reduction to practice in the eyes of a big strategic partner and reduction to practice in your eyes is still typically miles apart. So I think Mark said it. I mean, the strategic partners say, oh, it's great. How many tons have you made in your pilot plant? For you, the pilot plant would have been beyond your wildest dreams of what you were going to make. And they're saying, well, how much you made in the pilot plant? So the trouble in that point, in that discussion, is going to be whether or not you can ever reap the rewards, because they will start discounting the value of your own technology dramatically if you haven't taken it all. If you haven't taken it across the goal line, you haven't scored points in their eyes. So one of the things about, if you have a licensing business model, or a business model where you intend to monetize through an early exit, just be very clear on the milestones and know that those partners out there are willing to accept those milestones. It's a hard thing to get codified, but I do know that, having worked in a big company, I said this a couple days ago, the problem with the big company is they will tell you, oh man, I love what you're doing. If you can do this, then we can talk again about doing a deal. Well, you go and do this and say, well, what I really meant is, can you do this? Okay, I'll go back and do it. And you do that. I said, what I really meant is you do this. And so it's a target that just keeps moving on and on and on. And so it's a very tough game to play unless you have, real tenacity. So have credible milestones that you think your partners also will believe in, and not keep, pushing the rock ahead so far that you'll never catch the target. That's really dispiriting. Yes.
There's a question.
Oh, sorry. I'm sorry.
Hi, Steph Davis. Steph Davis with NeoCell Biotechnologies and Nova STEM Institute. I just wanted to give an update and get your opinion on a lot of the biochemical or biotech firms. They're trying to make things more focused with better R&D equipment, where they get quicker results, and also the drug discovery methods are a little bit more focused, like with the chemical libraries. So that will help, like from what I've seen or read about, what we're trying to do as well, to decrease risk and also control spending. They're getting like focused teams and project management, project groups to focus on specific drug discovery projects. So what do you think of that, and trying to change things to decrease risk and also get better profits and return on investments?
Yeah, I mean, I'm not an investor in the biospace. I can only say that when I was in graduate school, there were people that were starting to do combinatorial synthesis, and I'm not going to tell you when I was in graduate school, but that was a topic back then. All these methods these aren't new. These are methods that have been tried over the past decades with varying degrees of success. I think because of the amount of money it takes to take some of those products from conception to reality is so huge that those enterprises have to keep looking at ways to make it more efficient. It's just staggering how much money it costs. And they'll look at anything to reduce the cost of that and the cycle time to get it done. I just don't know whether or not there's been marked increases in success rates due to that investment. I don't know enough about that.
They change their model to make more money, to lose money, and they make more focus on research development teams and better equipment, like looking at QHT or screening methods, new equipment for that, and then away with a lot of the common.
Well, I'm sure when the CEO goes to the board says, you haven't delivered on a lot of new products. How much are you going to spend, and tell me how you're going to be successful? So as the CEO of that enterprise, you are under the gun to try a lot of new things. So I wouldn't be surprised that they're looking at uncovering anything under those rocks out there that could be valuable. I just don't know of the success rate of doing that. I'm not surprised. It's a big money game, and a lot of it isn't successful. So maximize the use of those resources, I assume, is a very strong priority for those businesses.
So I'm going to dig a little bit deeper into how you evaluate things. I mean, looking at all the companies that you have out there, they're all over the place. I mean, there's Ticket Leap, there is Neat, there is CD Now, all over the place.
Right.
But in some ways, you make a judgment call, as in when you're evaluating two companies, this is probably better, worth it for us to invest in than the company B.
Right.
Is there something common in there that, say, you follow, but is also true for within an entrepreneur when he's looking at two areas of business to focus in? He's looking at, shall I go and develop this molecule versus I go and develop this line of business?
Yeah.
Are there commonalities? It's a very general question, actually.
Yeah, I mean, I'll answer a couple ways. First, I didn't show the slide of all the companies that didn't make it, obviously, so I didn't show that slide. But, maybe some commonalities. Maybe one commonality is, if the business model anticipates a relatively large market, we would suspect that when the addressable or accessible market is really defined, it's going to be smaller. But if you start off with a bigger number, even if it gets refined downward, it still is an attractive place to play. If you're starting with a very small market and you miss on your addressable market size, you're going from small to infinitesimal. So certainly we want to maybe stay away from that. Clearly people look at the team and the capabilities of the people. Because what I've noticed with companies that have made it is that, remember I said no one has ever hit a business plan, which means that a few months into your business plan, you are on a redirect that you weren't anticipating. So the question is, how nimbly can you do a redirect? How nimbly can you change where you're going, what you're doing? Entrepreneurs don't want to give up the ghost. They do not, they will, but the best ones can say, okay, that doesn't work, but here's a plan that I can get here and it's a different target. And so if people have done it before, or they have people who are advisors that have done it before, then what you say is that when things get really rough, these are the folks that maybe can bail out a failed business plan. When I say failed, everyone's going to fail, but just they'll be able to redirect easier and better. So you look for those kind of skills and capabilities too. But I think Michael mentioned there's a lot of luck. I mean, just some intuition, saying, "Geez, I like this." You know, the macro drivers in society and industry say that this is gonna, this seems like, it seems like this is gonna happen. Maybe these guys can't do it at the speed they want, but this is something the market really needs. I mean, we're going as a society or as an industrial base in that direction, and this is consistent with that. So if it's aligned with some of those macro drivers, that's really, really important. So those are just, I mean, that's at the highest level. But again, I could show you the slides of the companies we missed on. So we don't have a, our record is not perfect by any means, but I don't think any venture investor group can say that.
Mark, maybe getting back to your question a little bit, do you have like a certain hour set that you have for due diligence that you apply to everyone, or?
No, I mean different business plans. Between the time we do our technology checkpoint and the investability checkpoint, it's about 6 or 7 weeks. We hire some folks that'll do due diligence reports. They spend many, many hours, probably on an hourly basis. They're not compensated real well. They actually put a lot of time in. And so we end up getting maybe a 15 or 20 page summary report of the company, and then we do our own due diligence internally. But there are some companies in the technologies, frankly, some things are easier to get, some things are a lot more complicated, and you just got to dig in more. So I don't think it's not standard. I spend some time more on patents, looking at patents. And I didn't see the presentation today, but the thing about patents that's dangerous for me is investors love patents, but I always think that investors don't know enough about patents to understand why they love them. But it's a checkbox. Oh my God, you got a patent, great. No one ever looks at the claims of the patent. No one ever looks at any of the real critical things. I mean, that's a business asset, and they don't delve in deep enough to know. So so entrepreneurs sometimes say, "Oh, I got 2 patents." Well, can I ask you about the patents? What are your claims? Oh, I don't really know that. What do you mean you don't know that? It's the key asset you have. You don't know what your claims are? Well, I have to check with my lawyer, and these are the founders. So, so some of those companies, if the expression of value relies a lot on the fundamental intellectual property, we'll do more diligence around the patents and claims. That's not fun. Yeah, that's not fun. Because we know that fundamentally, if we are a note holder, and if the company bails or can't make it, we would have a lien to the technology, and we would say, could we recover any value from this technology? If the patent is purely incremental or is not fundamental, then we're not getting anything from that.
Okay, Mark, excellent presentation. Let me just ask your perspective. Most of the founders, they have technical background. And I would say 150% of the times they're more than married to a given project. Mm-hmm. But when they come to you or to investors, they see something else in terms of opportunities and redirecting them to a different market or a different application. How do you guide and coach those individuals that forget about the original idea? This has a bigger potential in a different direction.
I would say initially the funding is premised on the founder's vision. That's what they're selling. So typically you will subscribe to that vision of the market and the opportunity. It's only when those first milestones aren't hit that you start saying, okay, well, is there a better plan B? And plan B usually arises because plan A hasn't come to fruition. I think founders can be reluctant to change their vision, but I'd say most of them are fairly practical, that if plan A is not working, and they need to raise money, and the only way they can raise money is if they start working on plan B, then very quickly they realize that they're beholden to the interests of that money, and they need to change. Otherwise, the company has no future. So I think honestly, investors in the beginning will give you a lot of latitude because you come to them with a plan and milestones. I'm going to hit this. Say, okay, fine. We're investing on that premise. If you're one of the very, very few that deliver on it, life is good. If not, then you really need to adapt.
Okay, I'm going to be a terrible host, and I'm going to ask the last question before we take a break for our reception. So, Mark, people change, things change. You have an alignment of the interests between a mentor or an advisor early. There's no conflicts. that changes. What advice could you offer to our entrepreneurs as to constantly keep a check on making sure everyone's aligned in the same direction?
Yeah, that's, that is a challenge. I don't know if I have good advice, because even companies that are doing somewhat well, you'll have, there'll be board members that think this is the market should be served, and other people think this is the market you should be attacked, or this is the real problem, the business needs to be solved immediately. This is the, so I think getting 100% alignment, I don't know, I think it's a rare case that I've seen that. So my suggestion would be, number one, again, being brutally honest about where you are in your business and communicating that, so everybody's working from the same set of data, right? So if you're not all working from the same assumptions, there'll be dysfunction anyway. So make sure that you're brutally honest about where the company is, what the challenges are, so you can all work together from a common set of assumptions, and then just do your best to to use data to drive the decision. I mean, if you think this is a better market, okay, why is that a better market? I mean, intuition becomes less important and it's more data driven, and so bring information to the table to support your case and contention, because if you don't, it just becomes, well, I think you should do this. No, I think you should do that. And it's very hard to resolve.
All right, now I'm going to be a good host, and I'm going to ask each of you also to join me in thanking Mark.
Thank you. All right, thank you.